you ever wondered about the mysterious forces that influence the markets you trade? Ever puzzled over sudden market reversals? Hello friends, welcome back. Today we're delving into one of the fundamental pillars of trading, support and resistance. Whether you're into Forex or CFDs, mastering these concepts can make all the difference. So let's jump right in. So what exactly are support and resistance? Well, they are key price levels or zones at which the price tends to either bounce back or face resistance. Let's start with support. This is the price level where the market tends to bounce up. Why? Because at this level, buyers are stepping in, outnumbering the sellers, and essentially pushing the price higher. It's like a safety net that prevents the price from falling further. Now, on the other side, we have resistance. This is the price level where the market tends to face a barrier. Here, sellers outnumber buyers, creating a situation where the price struggles to move above this level. It's like a ceiling that the price finds difficult to break through. Before moving ahead, let me test you. Answer a simple question. Why did the support and resistance levels go to couples therapy? They needed to work on their communication issues and stop breaking up all the time. Well, coming back to the topic, support and resistance levels can come in different shapes. They might be horizontal, following a consistent price level, or they could be diagonal or even curved, depending on the trend line or moving average connecting them. Also, they can be dynamic, changing over time, or static, remaining constant. Now, a question arises: why should you care about support and resistance? Well, understanding these levels gives you a glimpse into market psychology. When the price approaches a known support level, you might anticipate a bounce or consider a buying opportunity. On the other hand, near a resistance level, you might expect a reversal and think about selling. Now that we know what support and resistance are, the next question is, how do we identify them? Identifying support and resistance is like reading a map in a foreign language. You think you're heading in the right direction, but suddenly you're lost in translation. Well, that's not the case. I'll make it easier for you. The first way is to look for obvious points. Look for those spots on the chart where the price has clearly reversed or paused in the past. These are like the landmarks of the market, and traders should keep them in mind. These levels can act as potential support or resistance in the future as traders react to these familiar zones. Next, we've got trend lines. These are straight lines that connect two or more points on a chart, showing the trend's direction and slope. Trend lines can act as dynamic support or resistance, adjusting with the changing price action. Now, the third way is moving averages. These are indicators that calculate the average price over a certain number of periods, smoothing out fluctuations and revealing the market's overall direction. Moving averages act as dynamic support or resistance, following the price movement and providing a buffer zone. Moving on to the fourth way, Fibonacci retracement levels. These are horizontal lines that divide a major price swing into percentages based on the Fibonacci sequence. They act as potential support or resistance, representing possible retracement levels of a trend. Did you know why the support level broke up with the Fibonacci retracement? It realized it needed space to grow and it couldn't be constrained by mathematical ratios. Well, moving on. Last but not least, we have pivot points. These horizontal lines are calculated based on the previous period's high, low, and close prices. Pivot points can act as potential support or resistance, marking possible turning points in the market. They're like the strategic checkpoints that you need to watch out for. Moving on to the next bigger question, how to trade support and resistance. Trading support and resistance is like trying to fold a fitted sheet. Everyone claims they know how to do it, but deep down, we're all just winging it. Coming back to the topic, identifying support and resistance is just the beginning. The real magic happens when you incorporate these levels into your trading strategy. The first way is through the bounce strategy. This is when you trade in the direction of the prevailing trend, expecting the price to bounce off a support or resistance level. For instance, in an uptrend, consider buying near a support level, anticipating the price to continue its upward movement. Conversely, in a downtrend, you can sell near a resistance level, expecting the price to continue its downward path. The next way is through the break strategy. This is the opposite. Here you trade against the prevailing trend, expecting the price to break through a support or resistance level. In an uptrend, you might sell below a support level, anticipating a new downtrend. If you're in a downtrend, consider buying above a resistance level, expecting the start of a new uptrend. But here's the crucial part. Don't trade in isolation. Use other technical tools, indicators, oscillators, candlestick patterns, chart patterns. These are your allies. They help confirm your entry and exit signals. It's like having a team of experts guiding your trades. And of course, always protect your capital like it's your superhero power. Utilize stop loss orders, position sizing, and trailing stops. These are your shields against market volatility. Now, we're going to explore 3 different types of support and resistance: horizontal, diagonal, and dynamic. Stick around because knowing how to use these effectively can be a game changer in your trading strategy. First up, we have the classic horizontal support and resistance. These are your go-to levels drawn by connecting points where the price reversed or paused in the past. The horizontal support line connects the swing lows, and the horizontal resistance line connects the swing highs in a chart. They can act as potential barriers in the future. Check out this daily chart of Euro USD. Those horizontal lines, they mark significant levels where the price bounced or broke through. These levels can define trading ranges in sideways markets or indicate trend continuation or reversal in trending markets. When trading these levels, keep a few things in mind. The more a level is tested, the weaker it becomes. The more significant a level, the stronger it is. The longer it holds, the stronger it is. And the closer it is to the current price, the more impact it has. Once my friend tried to locate horizontal support and resistance, but it's as elusive as my neighbor's cat. It's always there when you don't need it and it's disappearing when you do. Now let's talk about diagonal support and resistance, also known as trend lines. These are drawn by connecting points that show the direction and slope of a trend. Check out this daily chart of GBP USD. Those diagonal lines, they represent dynamic support and resistance. In an uptrend, they show rising support connecting higher lows. In a downtrend, they show falling resistance connecting lower highs. Traders can use these lines to trade with the trend or spot potential reversals. When dealing with diagonal support and resistance, remember these tips. The more points a trend line connects, the more valid it is. Steeper trend lines are less sustainable. The longer it holds, the stronger it is. And the closer it is to the current price, the more relevant it is. Diagonal support and resistance feels like arguing with a GPS that insists on taking the scenic routes. Sure, it's pretty, but can we please just get to the destination already? Lastly, let's talk about dynamic support and resistance. Understanding dynamic support and resistance is as challenging as explaining social media trends to your grandparents. It changes so fast and they're left wondering why anyone even cares. But don't worry, I'm gonna make it easy for you. These are not your typical fixed lines. They're dynamic, moving with the market. One popular method is using moving averages. For example, the 20-period exponential moving average, or EMA. It reflects the average price over a set period, smoothing out fluctuations. In a trending market, it shows trend direction and potential pullback areas. When trading dynamic support and resistance, consider these factors. The more time periods a moving average uses, the smoother and slower it is. The fewer periods, the choppier and faster. The longer it holds, the stronger. And the closer it is to the current price, the more impact it has. Dynamic support and resistance in the market are as reliable as a weather forecast in England. You think you've got it figured out, and then suddenly it all goes sideways. What if I told you that support can become resistance and vice versa? Yes, it's true. The phenomenon of role reversal. This adds a fascinating layer to your analysis, and knowing how to navigate these transitions can give you a significant edge in the market. It's like support and resistance decided to switch roles. It's like the Forex market is having an identity crisis, and I'm just here for the unpredictable drama. The concept of role reversal comes into play when a level that was previously support transforms into resistance, or vice versa in the Forex market. Imagine a currency pair that was in an uptrend with a strong support level. Now, if the price breaks below that support, what used to be a floor becomes a potential ceiling, a new resistance level in the world of Forex. On the flip side, picture a downtrending currency pair with a robust resistance level. If the price manages to break above that resistance, it can turn into a new support level. So the roles switch. What previously held back the price now supports it. This role reversal phenomenon adds a dynamic layer to your Forex analysis. There are several reasons for role reversal in Forex. Market sentiment can shift due to changes in economic conditions, news releases, or other external factors. Additionally, large institutional traders and algorithms may strategically enter or exit Forex positions at these key levels, influencing overall market sentiment. Understanding the why behind role reversal helps you anticipate potential trend changes in the dynamic Forex market. Thank you for watching this lesson. If you have any questions or even topics that you'd like us to cover in future videos, please drop them in the comments below. Don't forget to like this video and subscribe to our channel. See you in the next video.